The world's most influential oil alliance, OPEC Plus, led by Saudi Arabia and Russia, is once again opening the taps. Beginning August, the group will increase output by 548,000 barrels per day, a move that will fully unwind production cuts by September, a year ahead of schedule. It's a decision that comes despite weak demand, falling prices, and global market already showing signs of oversupply. This strategy isn't new. OPEC Plus has previously tried to protect market share by ramping up output. Each time, the results have been turbulent, sometimes even catastrophic, for oil markets and for oil-dependent economies. So what's driving this decision now, and why does history suggest it could be a gamble? Let's unpack Syed Rashid Hussain's Business and Finance article. OPEC Plus is adding supply even as demand slows. In China, consumption is cooling. Non-OPEC producers from the US to Canada, Kazakhstan to Guyana are steadily increasing production. Global inventories are rising, with S&P Global predicting supply will exceed demand by 1.25 million barrels per day in the second half of 2025. This surplus is already pushing prices down. Forecast by S&P, JP Morgan, and Goldman Sachs suggest crude could fall to as low as $50 per barrel and possibly lower. This decision does coincide with the summer driving season, which typically lifts fuel demand, but analysts say this uptick won't be enough to stabilize prices long-term. For OPEC Plus, the concern isn't just price, it's market share. US shale oil becomes a serious competitor with flexible production models that undercut traditional exporters. As American output climbs and new producers gain ground, Saudi Arabia and others are keen to avoid being edged out. There is a geopolitical layer too. By softening the oil market, OPEC Plus appears to be aligning with the interest of the US President Donald Trump, who is prioritizing strong ties with Saudi Arabia and its regional allies. But history offers a cautionary tale. In 2020, during the pandemic, Saudi Arabia and Russia launched a market share war. Both flooded the market, with oil prices collapsed at one point, even turning negative. The US had to step in order to broker a truce, urging both sides to cut production. Back in 2014, a similar playbook was used. OPEC refused to cut output, hoping to squeeze out high-cost US shale producers. The result, oil prices plunged by 70%, hitting levels not seen since 1980s. The economic fallout was significant, and the strategy backfired. And in the 1980s, Saudi Arabia once again ramped up production. Some argue this was in alignment with the US efforts to economically weaken the Soviet Union during the Cold War. The market crashed then too, and Saudi oil revenues plummeted. Each of these moments followed a familiar pattern: aggressive supply increases, falling prices, economic strain, and eventually course correction. Today, OPEC Plus finds itself at a similar crossroads. Increasing supply in a saturated market may help protect short-term market share. But if prices fall too far, oil-dependent economies, especially those with limited revenue streams, could suffer. As history shows, market share wars may feel like bold moves, but they often come at a steep price, and this time may be no different.